Hello and welcome to Lapping Analytics. My name is Jimmy Lapping. I'm a psychologist and statistician with an interest in a range of topics, including the financial markets. And in this video, I'm going to focus on the question trying to predict next month's stock performance using large language models on the one hand and humans on the other hand. Why is this question important? Well, the idea is, of course, if you can accurately predict which months, which stocks are going to outperform and which stocks are going to underperform in a given time window. I mean, in this video, we're going to focus on a month, but often, of course, for investing, the time window is much larger. It's actually recommended to be several years, for instance. But okay, if you can accurately predict which stocks are going to outperform and which ones are going to underperform, of course you can make better decisions regarding which stocks to buy or which ones to ignore or where to go long and where to go short, and you will make more money. And of course, for that reason, there are people who work for financial institutions that have been in the business of recommending to other people which stocks to buy or sell, where to go long, where to go short, with the idea that people could make more money. Now, there is quite a bit of research which shows that humans are not that good at consistently outperforming the market that way, that it's actually not that easy to predict accurately in a consistent manner, that is over time, which stocks are going to do well and which ones are not going to do well. With the rise of large language models, more and more people seem to be using programs like ChatGPT, for instance, with questions like that, which stocks are going to outperform, which are going to underperform, and try to make decisions based on whatever ChatGPT spits out. Of course, that is also based on the idea that large language models outperform humans in this job and also outperform the market, because if they don't, then you might as well do something else. So that's exactly the question I'm going to focus on in this video. So what did I do? Well, I'm going to draw a comparison between, on the one hand, three large language models, ChatGPT 5.2, DeepSeek version 3.2, and Claude Sonnet version 4.6. All three, the free versions, that's important, so it's not the paid, the commercial versions of these programs, no, the freely available versions that you can use for free without paying. And on the other hand, I'm going to focus on an expert panel and the readers of it's actually a Dutch environment for investing in stocks, which is IEX. Why that comparison? I'm going to explain that in a minute in a bit more detail. So what I'm going to do is compare the performance of the three large language models on the left and the two groups of human decision makers on the right for 30 AEX listed stocks. AEX is the Dutch large cap index. It's the Amsterdam stock market, and so it's the 30 largest stocks only listed in Amsterdam, so they are listed in the large cap index. And what I did, I mean, at the end of February, I made the predictions for how these different stocks were going to do in the course of March 2026. So for experts and IEX, I was not the one asking questions, but IEX once a month they launch a survey where people can decide for each of these 30 AEX listed stocks which of these stocks are going to outperform, which of these are going to underperform. So for each of these 30 stocks, you then get a balance based on the number of people that respond to that survey. Either a stock is more in the outperform category, or it's more in the underperform category, or it's somewhere in between. So I call that none of the above, kind of neutral, or at least neither outperform nor underperform. This is a question that is asked once a month to a panel or a group of experts in the IEX environment. And on the other hand, there is also the readership of IEX, which are, well, could be a mix of experts and novices and intermediates. But they answer the same question. So to approach that as well as possible with the large language models, what I did was basically on the last day of February, after the market close in Europe. Actually, I did this even after the market close in the US, which is several hours later, about 4.5 hours later. So the last trading day of February 2026 finished today. So this is the prompt that I gave on the 28th of February 2026. The Amsterdam Exchange Index, AEX, is the most important stock index in the Netherlands. Of those companies currently listed on the AEX in the month of March 2026, question 1, which ones are most likely to outperform? And question 2, which ones are most likely to underperform? Right? So the idea is that for each of these 30 AEX listed stocks, I would get so some would come in question 1. Those would be the outperformers. Some would go to question 2. Those would be the underperformers. And the ones not mentioned in any of these categories, they would be somewhere in between, right? So I use this prompt to get an outcome as comparable as possible to the two human groups that made these predictions for the month of March. What we see is that so here we have the performance for these 30 stocks for each of the 5 sources. So you see ChatGPT 5.2, DeepSeek version 3.3, Sonnet 4.6, the IEX expert panel, and the IEX readers. You see here, and this is the number of stocks in the AEX that were categorized as so predicted as underperform, neutral, or outperform. So you see that these numbers, they differ between large language models and also between the expert and reader groups. This is of course because each of these 5 sources yielded an independent outperform, neutral, underperform classification for each of the 30 stocks. So these numbers are going to be different. No missings. And then here the mean and the median, they are two different measures of central tendency. I've used both because the mean, of course, is somewhat sensitive to extreme cases. If there was a specific stock that had like a very sharp underperformance or overperformance, well, then the mean is of course influenced by that one case. For the median, it's not the case because it continues to be the middle observation, or in this case the average of the middle 2, because it's 30 stocks, that's an even number. So 2 measures of central tendency. And what we see is when we look at ChatGPT, we see that the average performance, so let's focus on the mean for instance for a moment. For the average performance of the stocks that were predicted to underperform was -4%, -4.1. For neutral, it was actually worse, and hey, for outperform, it was even worse. So this is exactly the reverse of what you would want to see. In this case, it had to be followed ChatGPT in terms of underperform, neutral, outperform. Had we based our decision making on the recommendations of ChatGPT, we would have probably lost more money. Right? I mean, March was in any case not a good month for stocks because, well, it was a month that was dominated by geopolitical tensions in the Middle East, especially around Israel and Iran. And so there was a general tendency towards poor performance of stocks in the month of March. as anyone or most people who have invested in stocks will have noticed. I mean, very few things outperform, maybe some oil stocks, but most of the sectors were clearly down in the month of March. Now, but of course, what you wouldn't want to see is that the stocks that were predicted to outperform in the end actually underperform relative to the underperformers. That is something you just don't want. And you see a similar tendency for the median, in the sense that also the best central tendency is found for the underperformers, and then so the outperformers are notably worse. We see actually something similar, although not that strong, for DeepSeek. We see the worst performance for the ones that were neither classified as underperform nor as outperform. So neither likely underperformers nor likely outperformers, those that had the worst performance. But you see that the central tendency for the outperformers is actually again slightly lower than for the underperformers. And again, we see the same for Claude, Sonnet 4.6. Although you could say even more extreme. Here, minus 11%. So the average performance of the ones that were predicted to outperform, the median also close to minus 10%. Well, it's not that drastic for the underperformers. I mean, not that drastic, of course. Normally, in a normal month, losing 5% or 6% would be a lot. But, well, March was a month when nearly everything came down to some extent, some more than others, of course. But, well, you wouldn't want, again, the worst performance to see in the category of stocks that were supposed to outperform. So this is something that the three large language models have in common for this month. Yet when we look at the IEX expert panel, you see actually at least that the tendency is in a better direction. I mean, okay, you see that, for instance, the median and the mean, depending on which one you use, either the outperformers do best or the neutral ones, but at least you can see that the ones that were predicted to underperform, indeed, they clearly had a lower performance, a poorer performance, right? This is the direction you want to see, that the underperformance, the ones that were predicted to underperform, indeed show the poorest performance. Followed by the neutral ones, which you see when you take the mean, and then the outperformers, the best. Here, okay, when you use the median, you see that the neutral ones do a little bit better, but at least the underperformers, the ones that were supposed to underperform, well, there the tendency is underperformance indeed. And you see something similar. You could even argue a slightly stronger contrast for the readership. You see that in this case, both the mean and the median show an order that you would want to see, namely that the poorest performance is found in the group of stocks that was supposed to underperform, and the best performance is found, relatively speaking, of course, because negative numbers are normally not good. But okay, March was not really a normal month. But what you would want to see that, okay, the poorest performance found in the underperform category, and the relatively speaking best performance in the outperform category. So in this case, the two human groups show a tendency which is, well, more or less in line with what you would want to see with this kind of predictions. While for the large language models, even though we had a fairly simple, I mean, I think it was quite a straightforward prompt. If you have any suggestions for other prompts, you can always leave them in the comment section below the video. I'm happy to try them out for future months. But I mean, this clearly shows that the large language models go in the wrong direction, which is, of course, not what you want to see, unless you want to lose more money, of course, which no one investing wants to do, I guess. So here you see, from a slightly different angle, a more graphical presentation of the numbers that you saw before. Here we take the means as points. So you see what you would want to see is what you see for the green line and the red line, which are the IEX groups. You see their outperformance performance is it so the average performance for the outperform group is fairly similar. Also for the neutral group. For the underperform group, you can see that indeed the IEX readers had slightly better choices. So the contrast is slightly better for the readership than for the expert panel. But well, it's small differences, as we will also see in a minute. And well, as we saw for each of the three large language models, the dot in the outperform category is lower than the dot in the underperform category, which is really not what you want to see. The clearest it is with Claude, with Claude Sonnet 4.6. Okay. Well, what I've done here is to basically like perform some regression analysis where I took the performance, so the monthly percentage change as a dependent variable, and then I used either one of the three large language models or one of the two human groups, or later also modeled with both human groups, and to see which of these models performs best. Well, what do these numbers mean? AIC and BIC, they are so-called information criteria. Here, although there are different rules for decision making, one of them is that the lower this value, the better. And these information criteria are basically a trade-off between model complexity and model performance, which is to say, if you can achieve about the same model performance with a less complex model, then generally the less complex model is to be preferred. So more complexity is only rewarded if the performance is also substantially better, with the difference that AIC is slightly more liberal in the sense that it is slightly easier to prefer a more complex model, and BIC is a bit more strict. The more complex models need to really perform better in order for the BIC to indicate a preference there. And the R squared is the percentage of variation explained by the model, which is a positive number because it's a squared number. But the reason why, for instance, these three large language models are in red is because we saw that actually the direction is the other way around. That the worst performance was found on average for in the outperform category, while the ones that are in green here, the direction is at least is correct. Well, two sets of numbers stand out. First of all, the IEX readers, which give the lowest AIC and BIC numbers of all the models that have at least one of these sources. Explains about 7.6%, not a lot, but it's something. But a second set of numbers is that basically the kind of a null model, or a model that says you might as well roll a die, and for instance say one or two is underperform, 3 or 4 is neutral, and 5 or 6 is outperform. And so such a model of random allocation, or of you toss a coin or throw a die. I mean, the R squared statistic is 0, because the idea is that on the long run, such kind of random decisions should not result in outperformance. But what you see is that the AIC and BIC for this model are lower than for any of the other models, which is basically to say that even the human groups, experts, readers, or combination thereof, do not outperform substantially the all the same or random allocation model. But of course, we have to put a note of caution here, that of course it's just 30 stocks, it's 1 month, it's a fairly small sample. If we were to do this for a longer period, it's possible that one of the other models would outperform. The readers probably then being first, because normally 7.6%. I mean, if this was a larger sample, an R square of 7.6% would normally result in more favorable AIC and BIC values. But well, there is no guarantee that we would find that R squared in a larger sample. So I'm going to be doing this for several months more to see how the picture, what picture emerges from that larger sample. But it is kind of in line with what I've shown in two previous videos on my channel, in the sense that there is there is no clear evidence that humans consistently outperform the market, that they are really good at predicting which stocks are going to outperform and which are going to underperform in the next month or so. In that case, we can say, and another important message from this video, I think that's the most important, because I mean it's a small sample, so to say, okay, the readers didn't substantially outperform all the same model. Okay, it's a small sample, it's a limitation, but what we do see is that the large language models not only underperform relative to the IEX experts and readers, but the performance that we see there is kind of in the opposite direction that we would want, and that conclusion you can draw even with the relatively small sample that we have that we've had. Okay, another note of caution. March was a somewhat of an unusual month because, well, with the whole geopolitical situation around Iran, well, many sectors have behaved differently than they might have in other months. But well, that's exactly inherent to predicting stock performance, because there can always be surprises, right? I mean, now it was a geopolitical situation. Maybe in a few months from now, it's an interest rate hike or a cut by some central bank, or increased or decreased risk of recession. So there can always be something, or uptick of inflation, whatever. So there can always be something, and that is exactly one of the reasons I think why it's so difficult to look ahead for 1 month and say, yeah, in the next month these stocks are going to outperform and these are going to underperform, and then expect that you can consistently make money like that. But I think, I mean, as for all my videos, it's not intended for investment or trading advice. That is something I want to make crystal clear. Um, but and in any case, I hope that I have shown that it is not as easy to just ask ChatGPT, hey, which stocks are going to outperform and which are going to underperform, and base your investment decisions on that. It's really important, and that's something I stress in all my videos. If you invest, do your own research. There are many ways of doing that. Don't just blindly put something in ChatGPT and expect, or DeepSeek or Sonnet or whatever large language model you're using, and somehow blindly trust that that will give you a good performance in the next month or so. It just doesn't work like that. So, having said, I hope you found this interesting. If you have any questions or comments, feel free to leave them in the comment section below the video. Uh, if you enjoy this kind of content, you will find plenty more on my channel, Lapping Analytics. Check it out. Thank you for watching, thank you for listening, and I hope to see you in a next video. Bye bye.